The year 2024 has been a wild ride for investors, filled with unexpected twists and turns. Markets around the world took a sharp downturn, sending shockwaves through the global financial system. This sudden drop was a shock to many, leaving traders and investors scrambling to make sense of the chaos. It all started with growing worries about the US economy, which had been showing signs of weakness. Some experts believe a recession is coming, predicting a prolonged period of economic hardship. This fear led to a massive sell-off in stocks, as investors rushed to protect their assets. The situation worsened with troubling news from the job market, adding to the overall sense of unease. Fewer jobs were created than expected, making investors nervous about the future economic outlook. The Federal Reserve's interest rate hikes, meant to control inflation, seemed to be backfiring, causing more harm than good. These hikes might actually be slowing down the economy too much, leading to a potential economic slowdown that could last for years. The US market crash sent ripples across the globe. Asian markets were hit particularly hard. Japan's Nikkei 225 index experienced a dramatic fall, the worst since the infamous Black Monday crash of 1987. This plunge reflected a widespread loss of confidence in global economic stability. The European markets mirrored this downward trend. Major indices across the continent dipped significantly. Investors were clearly reacting to the uncertainty stemming from the US, selling off assets and seeking safer havens. The interconnected nature of the global economy meant that no market was immune to the panic. The tech sector, often seen as a bellwether for the market, felt the heat intensely. High-growth technology stocks, especially those in the artificial intelligence field, took a major hit. NVIDIA, a leading chipmaker for AI applications, saw its stock price plummet. This decline wasn't limited to NVIDIA. Other tech giants like Meta, Amazon, and Microsoft also experienced significant losses. The euphoria surrounding AI seemed to evaporate overnight. Investors, once optimistic about the future of tech, pulled back, reassessing their positions in a rapidly changing market. Section 4. Investors on edge. The market crash left investors rattled and unsure. Some experts urged caution, advising against panic selling. They emphasized the importance of a long-term investment strategy, even in turbulent times. Others called for swift action from policymakers to stabilize the markets and reassure investors. The debate over the best course of action intensified. Some economists argued for a more cautious approach from the Federal Reserve, suggesting that further interest rate hikes could exacerbate the economic slowdown. Others believed that tackling inflation should remain the top priority, even if it meant short-term market pain. Section 5. Economic signals mixed. Adding to the uncertainty was a mixed bag of economic indicators, which left analysts and investors scratching their heads. While some data pointed to resilience in certain sectors, such as technology and healthcare, others signaled trouble ahead in areas like retail and manufacturing. Corporate earnings reports were also a mixed bag, adding to the confusion. While some companies exceeded expectations, posting record profits and celebrating their success, others issued warnings about the future, citing supply chain issues and rising costs. The conflicting signals made it difficult for investors to get a clear read on the health of the economy, leading to widespread confusion. This lack of clarity fueled further volatility in the markets as traders reacted to every new piece of information. The VIX index, a measure of market volatility, spiked to levels not seen in years, indicating the heightened anxiety among investors. Reflecting the heightened anxiety among investors, who were unsure of what the future holds for the economy. Section 6. Navigating the storm. The 2024 market crash serves as a stark reminder that market downturns are a natural part of the economic cycle. These downturns, while often feared, are inevitable and can be anticipated with the right knowledge and preparation. While they can be unsettling, they also create opportunities for discerning investors. Those who can identify undervalued assets during these times can potentially reap significant rewards in the long run. Those who remain calm, stick to their long-term plans, and avoid emotional decisions are best positioned to weather the storm. Emotional decisions often lead to panic selling, which can result in substantial losses. Diversification, a cornerstone of prudent investing, remains crucial. By spreading investments across various sectors and asset types, investors can reduce the impact of a downturn in any single area. Spreading investments across different asset classes can help mitigate losses during market downturns. This strategy ensures that not all investments are affected simultaneously, providing a buffer against market volatility. It's also essential to stay informed. Consult with financial advisors and make informed decisions based on your individual financial goals and risk tolerance. Regularly reviewing and adjusting your portfolio can help you stay on track and achieve your financial objectives even in turbulent times.